Hi, Greg Lewis, MetaStock Software. Your presentation will start in about 30 seconds. I just want to take a moment to tell you about our upcoming 10th annual MetaStock Traders Conference in Southern California and how you can save $200 when you attend. You're invited to join us on October 8th and 9th, 2016 for our largest annual event packed with valuable trading information you can use to improve your portfolio. You won't want to miss this opportunity to learn from industry experts like Rob Hoffman, Greg Morris, Oscar Carboni, Vince Vora, Price Headley, and more. If you'd like to register for this event or just want to find out more, visit metastock.com/conference. The first 20 registrants save $200. If you're seeing this after October 8th, 2016, visit metastock.com/conference anyway to see about upcoming events. Thank you, and we hope you enjoy this presentation.
Hey everybody, it's Jeff Gibby over at MetaStock. I hope you're doing well this afternoon or evening or morning, depending on wherever you are. Today we're doing another presentation on a universal exit strategy, and I'm going to get right to it. So let's go ahead and read the legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions made on the based on the use of the software, any trading strategies, or any information provided in connection with the company. So there we go. Let's go ahead and go to the next slide. Today we've got Roy Swanson. Roy, you're turning into a veteran of the MetaStock webinar room.
That's right, a veteran MetaStock webinar.
Presenter, right. Do you have any you've done? I've lost track.
Oh, this is probably somewhere around 10 or 12 at this point, yeah.
I know you probably just I know you're running tally, carve a little notch into your desk every time you do one, right?
I should.
All right. Well, let's Roy's a great presenter. That's why we keep bringing him back. Let me go ahead and turn everything over to you. Let's get the screen shared with you. So I'm going to go ahead and make you the presenter. It should send you a little message saying, hey, do you want to share your screen?
Yeah.
Okay. I'll let you know when I can see it.
Okay, hold on.
Can see it?
How's that? Good?
That looks it. I'd probably just maximize it. We can see the whole screen, so might as well make it big.
How's that?
No, it's fine.
Okay, thanks Jeff, and thanks everyone for coming. Here we are, the week after Brexit. Has it only been a week? Anyway, we're going to talk today about something that can actually help in situations like we've just been through. And the title of today's presentation is called A Universal Exit Rule. We have the same disclaimer that Jeff needed to present. I need to do it as well. I'll just give you the summary. We're not brokers or certified financial planners. Any results we show would be illustrations based on simulated historical trades. Past performance on this or any trading system is not indicative of future performance. This is really information that's our opinion solely to stimulate your own explorations regarding trading and have more fun with it, give you something to think about. So a little bit about me. I've been trading for 20 years, ever since the very beginning of the online trading era. In fact, they wanted me to work at DLJ, which was one of the first really good online brokers when they were just launching derivatives. And I hadn't even heard what is a derivative. I didn't even know back then, and I took a pass on it. But I did end up being a consultant to a lot of trading system providers in the years subsequent to that, about 25 years experience altogether with my partner, and you know, that gives you a good indication of the strengths and weakness of different trading systems. We've worked for about half a dozen of them, and even more important, why good traders sometimes have trouble even with a good system. Actually, what we talk about today will help in that regard. Today's agenda is real simple. It's about exit rules. Why are they hard? How you can define yours and how you can execute them. And you're welcome to also get a free copy of our book, Read This First Before You Buy Stocks. It's a big book up on Kindle, but you can get it for free. At the end of the presentation, I will tell you how to download a copy. This is about really what's changed in the stock market over the last, let's say, 5 years, why today's stock market is so different than it was even just a few years ago. So let's get to it. Really, this is a very pithy and contrarian seminar today. So the first question is why do you want an exit rule? Because we already know, I mean, let's face it, we already know the best time to exit, and that is never, right? Because we hear it all the time, and actually the numbers bear it out. Stocks tend to go up over time. If you have years, if you have decades, why not just hold them? Hold them for a long time. But of course, most of us can't keep our holdings for a long, long time. We want to work our money. So why do you want an exit rule? I think the number one reason we hear from traders, or that I hear, is this whole idea about getting the maximum possible gain from your trades. And this is the first myth about exit rules we need to debunk immediately, because this is a terrible reason to have an exit rule. Trying to get the maximum possible gain, squeeze the most pennies out of a trade, this is a bad answer for why anyone would want an exit rule. And because here's a typical trade. Okay, you're getting in here at the buy arrow, I made a big green triangle, and the trade goes up for several days. And then you just want to get the last possible couple of, half of a percentage gain on it, and bingo, stock falls off a cliff. Everything you waited for, your gains are gone. What was a good trade is nothing. And this is the problem with trying to get the maximum possible gain out of any trade. We call it trophy trading. It's like we're not trading. We just want to get trophies here. We want to get show a list of trades where we have these incredible gains and better than anyone else. That's not what it's about. Trading is about actually taking money off the table while it's real, in our opinion anyway. Trophy trading, as we call it, is a very dangerous hobby, and then that's why you see this 90-90-90 rule that's throughout the industry, which is that 90% of individuals lose all their money within 90 days of opening an account. And a lot of reason for that is by trying to squeeze the last few pennies out of every trade. So why do you want an exit rule? Well, as I just said, you want an exit rule because you want to take gains while they're real, before they disappear, before the stock decides to go the other way. And you want to make sure that your money is always working for you. This whole idea about, stocks will always go up in the long run, hold it for 5 years, 10 years, 15 years. Yes, that's true, but during that time, your money's not always going to be working for you. There are going to be times when it's up, down, sideways. An exit rule will help make sure that your money is always working for you, so that your money is not trapped in an underwater trade or a sideways trade. And finally, I think the most germane thing for all of us as we're trading is you really want an exit rule so that you can make your goals as a trader. I mean, isn't that what it's about? We're trading, we have goals. We want to hit certain markers. We want to hit a certain amount of income, profitability, whatever it is. And that is a good reason to have an exit rule. To hit your goals, you want to, basically, you don't want to end up in a current loss because you hung on too long. You want to exit somewhere in here. Anywhere in here is fine. Get the most of the run, but don't end up over here and be stuck with a loss you have to sit through and your money's not working for you. So how do people create exit rules? Well, the typical way is that people use the same tools they use for buy signals and entries, the technicals, indicators, oscillators, chart patterns, explorations in MetaStock, maybe something to do with fundamentals of the news, but all the typical kinds of inputs that you might use for an entry or a buy signal, people tend to apply to an exit rule. We really take a completely different approach because we feel that these tools that are used for an entry or for a buy, they're predictive and they're just not accurate enough. Because they're predictive, they don't always trigger. I mean, think about your entry signals. They don't always trigger. There's going to be some last hurdle, and very typically any trading system you could think of might only trigger 50 to 70% of the signals actually trigger the next day, meet that final criteria. So if you have an exit rule, that might not trigger as well. And if it doesn't trigger, well, what good is it? Because then, again, you're sitting there holding on to the loss. They're not always accurate because by the same token as a buy signal isn't always accurate, you might have an incredible system which gives you buy signals of 80%, and that's tremendous. But when you're talking about exits, do you really want to have an exit rule where 20% of your exits are not accurate and you're losing money? That's going to take a big chunk into your earnings. At the end of the day, any of these predictive tools the same ones that you use to analyze getting into the trade, they add significant uncertainty. I mean, think about it. When was the last time anyone predicted tomorrow's market correction? We just went through this crazy couple of weeks with the Brexit. Who predicted that? Did anyone really predict how it would run? Not that I heard of. I saw dozens and dozens of articles in the financial press about, gee, this didn't play out the way we thought it would. And think about it, if your exit rule was so good, wouldn't it be a standalone short strategy? But is it? I mean, how many times do people promote an exit rule as a shorting strategy? Because typically they're not. An exit rule isn't a shorting strategy. So that again starts to make us wonder, well, why are we using what I call predictive tools that just aren't accurate enough? So here's a completely different approach to create what we call a universal exit rule. And it starts by killing any dreams of having trophy trades, of squeezing the last penny out of every trade, and killing any thoughts of trying to predict a pullback because, again, we see time and time again, no one predicts pullbacks. Corrections always catch just about 90% of the people by surprise. To create a universal exit rule is easy if you trade systematically, if you have a plan, if you know your goals, you want to protect your gains. And so here's basically the way we approach it, very mechanically. First, don't let the word plan you, fool you, or scare you. Any systematic trader, I'm sure most of you using MetaStock, you have a plan, and that plan involves having position sizes, a certain amount you're going to buy for every trade, an average gain per trade. You know what your commissions are. Let's use that as a placeholder for costs. You know what your accuracy is going to be over the long term. Either you've tracked it yourself or you're using published results. And you have basically your plan has a certain ROI or return on investment for every trade. So let's just throw in some numbers here. Let's say you're making modest buys, a couple $1,000 trade. You're shooting for an average gain of 4%. Your commission, in this case, let's say it's even on the high side. It's 1% of a $2,000 buy. You're doing $10 in, $10 out, even though many people can get it, make that half. But let's use the big number for now. Let's say your accuracy rate in this case is very modest, but you're winning more than you're losing, so you could have a successful strategy here. And your ROI in a plan like this, with an average gain of 3%, your ROI of gain of 4%, sorry, and then 1% for commission. Your ROI is you're targeting $60 per trade, or 3% on a $2,000 buy. So really, that's all you really need to have as a plan. It's a certain goals, certain parameters that you think characterize or characterize your typical trade. And again, this could be something that you've kept a scorecard on your own portfolios, or you're using published results which have many years of results. Now, after the plan, you need goals. And here are the goals we use for exit rules, and there are 5 of them. The first one is your stop loss. The stop loss should equal the average ROI per trade. So in this case, that would be 2% below the entry. Because the first thing you want to do is you want to yourself if the trade goes south. It's always the number one job of any trader in our opinion. So we believe setting the stop loss at 2% below the entry, that gives you $40 gross loss, and with your commission, which was $20, that's a $60 net max loss. And if you remember from the previous slide, our plan is to make a $60 average net gain on every trade. So we're setting our stop losses 2% below entry. This is the beginning of an exit rule, because if the trade does go south, it's going to trigger your stop loss. Your trailing stop will trigger 2% below wherever you entered. The next goal, which we think is helpful, is the break-even goal. It's where you've covered your costs. And in this case, that would be 1% above the entry. 1% times 2,000 is $20. That covers your commission. The third goal is what we call the profit goal, and that's anywhere above break even but below your plan. So our plan was to hit trades of 4%. Our break even is 1%. So we might set a profit goal, the typical profitable trade at 2%. We're making some money. It's below our plan, but at least we're naming this goal our profit goal, and that's a 2%. 2% times 2,000 would be $40 gross minus the $20 commission would be $20 net per trade. The fourth goal we call the plan, and that's hitting your plan. As we said earlier, the average gain per trade in this system, this hypothetical system, would be about 4%, so we would set our fourth goal at 4% above the entry. $80 gross, $60 net. Again, that was our plan. Make $60 net per trade, net of commission. And the fifth goal is, for the lack of a better label, we'll call it icing on the cake. You're going above your plan. It's over 4% above the entry, so let's say we set it at 6%. Goal number 5, 120 gross, $100 net. And that's really basically it. You set your goals once per strategy. You have your stop loss. That's your worst case. You've got your break-even goal, which is, you at least want to break even. Do no harm, as they say in medicine, right? As a trader, you don't want to lose any money. Then you have your goal for making something of a profit. You've got your goal for making your plan, and you've got your goal for, your extra lucky days when you got an icing on the cake, when you're getting well over your plan. Once you've set those goals, and if you remember, we set these at 2% down, 1% up, 2% up, 4% up, and then 6% up. The process is very simple. Let's say you buy 20 shares at $100. You do your $2,000 buy. When you make the buy order, you set your trailing stop loss as soon as you can. You bought it at 100. You set it at 2% down, 98. You've covered. In case the trade goes the wrong way. And then you set price alerts. You set your price alerts at the other 4 goals that you made for yourself. You had your break even, your profit, your plan, and your icing. And as these alerts trigger, whether they hit your cell phone or your email, or you've got a window open on your online broker, you set a trailing stop as the stock hits one price alert after another. So again, these can be triggered to go on your cell phone. If you have a cell phone app, you can go set the tighter trailing stop at the next level up, and it's really just a question. It's not like you have to be tied to the screen, because again, we've all got many ways to communicate with our online brokers, all kinds of apps, and of course, in the worst case, you're sitting in front of the computer and you are staring at it. But as your position hits each one of these alerts and they trigger, you can set a trailing stop just under that goal, so that you keep basically protecting whatever gain you get. And as this one moves up from 101 to 102, hold on a second, you just keep setting your following trailing stops. And it sounds like a lot of work, but I mean, look at it this way. On a chart of a typical position, when you set your entry, you set all of these alerts. Step 1, you set all 5 goals and your trailing stop loss. You set all of these alerts and your stop loss, and then only as the stock moves and each of these alerts trigger, when the break-even alert triggers, you set the break-even stop loss. When the plan alert triggers, you set the plan trailing stop. When the icing on the cake alert triggers, you set your icing on the cake trailing stop. It's always a question of setting the trailing stop as these alerts trigger. Sounds like a lot of work. I don't know. You know, it's mechanical. This is what we like about it. It's mechanical. It's not predictive. It's certain. It's real. The money's there. You're just coming in with your trailing stops right under your alerts. There's no probability. There's no guesswork. It is what it is. You're basically setting the tools that the brokers give us and that internet communication gives us these days to basically be 100% confident of scraping this money out of the trade at a certain point. In some ways, this whole philosophy is supported by a lot of those reality TV shows. I don't know if you've watched any of them for restaurants and different businesses. You've got that guy, The Prophet. And in every case, they always go, they find the owner or the founder of the business, and they say, well, why is your business failing? And 9 times out of 10 it's because, well, the owner is not really minding the store. He hired his nephew or somebody else to be the manager here or there, and all of a sudden there's no more profits. Well, that's kind of the same principle here. We're talking about setting these alerts so that you keep an eye on your investments. I mean, isn't your investment in the market the same as any investment in a business that you might be running or as an entrepreneur? So the point is keep an eye on your investments, use the alerts, use the trailing stops, take the money off. What's really important is making your plan. If your plan reflects your average ongoing reality and the math is correct on your plan, you're going to have success. You're not going to have the most. Again, we're not trophy trading, or the least, but you are going to have success. Preventing loss, preserving your gains, making your plan. These are the 3, in our minds, parameters for a successful exit strategy, and you'll hit all of these by using this method. What's not important, again, making the most on a trade, which we think is just a seduction to the path of loss, and collecting trophies just doesn't cut it when it comes to making prudent exit moves. So that's it. Very simple strategy today. Something to think about. If you have any takeaways on this, it would be, again, exits are not about creating trophies, and they're not about predicting downturns. Exits are about making your plan. And this is a very mechanical way to build your plan. If you have any questions on this, please send me an email at steadytrader.com. My email is there at the bottom, info@steadytrader. We've got some tools on the site that'll help you build your plan. We showed a very, very simple plan, but we have a whole plan building model called the SST that you can take a look at on our site. We also have a trading strategy that's powered by MetaStock you can take a look at on our site called Greenlight Trading Strategy. And when you go to the site, steadytrader.com, you'll see a place right at the top in the menu bar to download a free copy of this book. Read this first before you buy stock. Please take a look at that book if you haven't seen it before. I think you'll find a lot of value in it. It's got a lot of good research about how the market has changed in the last couple of years. And that's really it for today's presentation. Thanks again for coming. I'll take a look at the chat board and see if we have any questions. Not seeing any questions, but we'll hold this open for a few more minutes. Quiet group today.
I'd say so. I'd say so. So in that case, I think we'll just say thanks for coming, everybody. Really appreciate it. And I think we'll close the room. Good job today.
Yeah, we will. Okay, thanks, Jeff. And thanks, everyone, for coming. Take it easy.